Welcome, dear students. This is Dr. Murugesh Reddy, Associate Professor, Department of Commerce, Wales Institute of Science, Technology and Advanced Studies, Pallavaram, Chennai. Today we are going to discuss about financial reporting from Corporate Accounting 1 in Lab 4, Unit 14. Let us see what is financial reporting, what are all the categories it includes, we will discuss. So, what is financial reporting? So, financial reporting means is the process of preparing the corporation's financial statements in accordance with generally accepted accounting principles GAAP. The statement prepared includes an income statement, a balance sheet, and a statement of cash flows. According to real estate dictionaries, the above meaning they are given, as well as it's a common meaning for financial reporting, as well as Wikipedia's dictionary meaning. A financial reporting is a formal record of the financial activities of a business or a person or other type of entity like partnership or company or an individual or a sole trading concerns likewise. So each and every financial concerns to prepare a formal record for their business activities. That is called as financial report. It should be disclosed to others, maybe for investors or creditors or financial institutions or general public shareholders likewise. That is called as financial reporting. That means it should be communicated to others. That is called as financial reporting. So, what are all the reports it includes in the financial reporting? So, annual report for a company. For a legal and necessity reasons, companies publish a formal report at the end of each financial year. The annual documents has three broad sections: director's report, financial statements, and auditor's report. That means that is called as audit report. So it should be classified into three. The first category is director's report, second one is financial statements, and the final one is audit report. So first we will discuss about director's report, what are all the items or what it includes likewise. So the first section of the annual report called the director's report, it's a narrative, often in the form of letter from the company's chairman to its shareholders giving three important piece of information. So what it is, firstly, a comment on the performance of the company during the year to which the report relates. This part is often referred to as OFR, that is Operational and Financial Review. Secondly, the assessment of what lies in the immediate future. Then the thirdly, a statement about the company's policies, principles, and strategies developed to meet the challenges of the future. So first, they have what actually occurred during the financial year. Second, what we should done in the future. Then what are all the policies created and principles and strategies to be followed to meet the challenges occur, overcome in the future likewise. Okay, so these are all the major important part disclosed in the director's report. So narrative part of annual report, and the narrative part of annual report is prepared with a great care. So they will taking care, most important care to prepare their annual report. Professional writers and designers are hired to touch it up to ensure its acceptability and appeal to the shareholders. Second, the number of graphs, charts, and photographs are inserted. That means it should be easily understandable by each and every members as well as general public. Only those issues are talked about which the management feels will be of interest of and appreciated by the shareholders. So what are all the discussions made in the annual general meeting, what all should be appreciated and interested by the shareholders, that only may be uh, recorded in the annual report. Sadly, Over recent era, this report has become to lose the considerable part of its creditability because of they may be some global crisis or economic crisis or unexpected events occurred in the global like this. Okay, as a more and more investors tends to look at it as a public relations exercise rather than a serious attempt to give meaningful information to their shareholders. That is the most important. So they have give more concentration related to the public relations exercise as well as give meaningful information to their shareholders. Then the second section of the report comprises for four financial statements, namely, that means the first stage is um, director's report. The second one is financial statements. So what are all the financial statements includes in the second category? A balance sheet, an income statement, a funds flow statement, statement showing movement in equity. So funds flow statement as well as cash flow statement. Okay, they have given four important statements. Each statement is accompanied with a large number of notes providing explanation of items therein. So each and every statement give large number of papers or notes because it should be provided more explanation what are all the items it includes like. So notes of accounts are considered in to be as an important as the account themselves as they provide an insight into the company's accounting policies and manner of treating various financial items. So each and every report, for example, preparation of balance sheet or income statement or funds flow statement or statement showing movement in equity, they must need to prepare notes to accounts, notes of accounts as per the company's Amendment Act 2013. Previously, they prepare the reports in the T format, that means ledger format. Now, at presently, they followed the prescribed format, statement format, right? For example, the method of computing and providing depreciation on fixed assets is a very important issue as it can have a significant impact of profit for the period under review because in the profit and loss account we have to post the debit side all the expenses and losses, on the credit side all incomes and gains only. But depreciation, it should be, it's not expenditure, it should be provided for the future needs. So, but it should be posted in the debit side of profit and loss account. That means it should reduce the particular years or current year's profit. So, that is the major important role played. Hence, financial analysts go through these notes or minutely as the financial statements themselves. This is the most important. So first statement is income statement. This statement shows the profit or loss made by the company in the year under report. While the statement may not be show clearly democratic, it is common for an income statement to have the following three distinct parts. So it's the most important. First one is trading account, followed by profit and loss account. Third one is profit and loss appropriation account. So what is trading account? This part shows the sales revenue earned by the company, the total of direct costs incurred to earn that revenue, and that resultant gross profit earned by the company. If in case adverse results means they occurred gross loss. Okay. So generally, almost all the companies earned only gross profit because it's a preliminary stage of financial statements, even income statements. Right? Then second one is profit and loss account. This starts with the figure of gross profit to which are added all incidental incomes arriving at the figures of gross operating profit. From this figure is deducted the total of all other expenses overheads to arrive at the year's net profit figure. So in the profit and loss account, we posted the debit side all the expenses and the losses, some provisions also. On the opposite side, that means credit side, we post a gross profit Then some incomes and gains. After checking the total of both sides, if we have the maximum amount in the credit side means we will get profit. If in case we have the maximum amount in the debit side means we will get net loss. Most of the companies prefer to earn profit only. Sometimes it occur due to some market situations or financial crisis or some market situations they may be occurred loss. Generally, most of the companies to prefer to earn profit. Correct. Then the next category of income statement is profit and loss appropriation account. This part show how the profit earned during the year is being used. From the figures of net profit for the year, deductions of applicable corporation tax is shown to arrive at the profit after tax for the years. So generally, the profit and loss appropriation account we must provide corporate tax and something transferred to reserves, special reserves like statutory reserves and other reserves likewise. Okay. So after deducting the corporation tax and the other some items, we will get surplus or deficiency. The surplus transferred to balance sheet, right? So the profit and loss appropriation account. To this figure is added to an unappropriated profit brought forward from the previous year to arrive a profit available for appropriation. The appropriations made in the year, example, transfer to reserves, write-off and intangible assets, recommendations to propose dividends, payment of interim dividends, etc. So these items be posted on debit side of profit and loss appropriation account are then listed total and the total deducted from the figures of profit available for appropriations to arrive at the unappropriated profit carry forward to the next financial year to the balance sheet, right? Then the next one is funds flow and cash flow statements. So statements show movement of funds generally taken mean cash and near cash items over the year. It should be appreciated that definition of accounting net profit is an increase in net assets or equity of a company arising out of its operations. An increase in net assets does not necessarily mean to increase in cash. A number of expenses not even paid in cash. Example, depreciation, provision for bad debts, likewise, or many have been booked but not yet paid. For example, accrued incomes or accrual expenses. On the other hand, a number of incomes may not be received in cash. For example, appreciation in the value of fixed assets or accrued incomes and may yet to be credited to the year's profit. Okay, so these are all the adjustments we not posted in the year's profit. At the same time, a part of cash earned out of the year's operations may have been used to increase the level of certain assets, for example, increase in stocks, or to retire debts, while some cash may have been received, for example, from shares issued or loan, getting loan from others, or issue of debentures likewise, without passing through the income statement. So we will get some information directly. So these are all the items posted in the funds flow statement as well as cash flow statements. This is the format prepared by KFC for the year 2011. So operating activities, so cash collected from customers, then cash payment to suppliers, cash payment to salaries. So these are all the items we have spent to some factors. Okay, so net cash flow provided to operating activities. So in this, they have mentioned three categories: cash collection from customers. That means it's related to credit sales. After we will making two payments: cash payment to suppliers, cash payment to salaries. After deducting these two figures, we will get net cash flow for the particular period. Then investing activities, sale of equipment, purchase of equipment. That means we sell some equipment, means we will get cash. Purchase of equipment means we spend something. So difference between these two activities, we will get net cash flow using for investment activities. Then financing activities, cash payment of dividend, retirement of common stock. So the difference, that means cash payment, then retirement of cash. These comes under the category of payments. So we will get the net cash flow used for financial activities. So overall, after adjusting these three categories, we will get total net changes in cash. So generally, the cash flow statement or funds flow statement provided in the T format. On the left hand side, we will post cash inflows or sources. Likewise, on the other hand side, right hand side, we will put cash outflows or applications or uses of funds like this. So the third category of financial statements is balance sheet. This statement shows the assets and liabilities of the company at the end of the financial year. It is customary in the all over in India, not only in Pakistan. So India, Pakistan, Nepal, and other countries. So first shows the liability side and then the asset side. Now, as per the Companies Act 2013, we will post in the statement format. Okay, so at the top we will post shareholders net worth, followed by non-current liabilities, that means long-term borrowings, then followed by current liabilities, then followed by we will post the assets part. So first one is non-current assets, followed by non-current investments, then followed by current assets. So the liability side shows the equity and long-term liabilities as well as current liabilities. As asset side shows the total fixed assets, intangible assets, investments, and working capital. Working capital means it shows current assets and current liabilities. Hence, each side of the balance sheet shows the total of capital employed. What is capital employed? So, equity plus long-term liabilities or fixed assets plus intangible assets plus investments plus working capital, or one more non-current assets plus working capital. These are all the formulas used for capital employed. Equity. The total of equity of a company comprises of its paid up capital, reserves and surplus, and unappropriated profits. That is called as shareholders funds or shareholders net worth. So what are all the items posted in the different categories of in balance sheet? Long-term liabilities. These are obligations of a company that are payable after considerable time, at least 1 year after the date of current balance sheet. That means it's exceed more than 1 year. That means what are all the amount received from in the form of loan, it comes under the category of long-term liability, maybe loan from bank or loan from others. It should be considered as more than 1 year. Okay. Then followed by fixed assets. These are the assets that a company uses uses to uses business, with example land, building, plant, machinery, equipments, vehicles, furniture and fittings, etc. So these are all the assets we can't able to sell it immediately. So that kind of assets comes under the category of fixed assets. Okay, then for next one is non-tangible assets. மா பேசிட்டு இருக்கோம், ரெக்கார்ட் பண்ணிட்டு இருக்கேன், ஒரு மேனஸ் வேணாமா? கிளம்புங்க. Okay. So non-tangible assets. These assets have no physical form but have value to the company as they are capable of improving its profitability. For example, copyrights, goodwill, trade marks, franchises, license, royalties, etc. So we can't able to see or touch or felt it these kinds of assets, but we can easily measure, right, as well as purchase. Then followed by investments. These are all financial assets held by the company. The company may own shares and bonds of other company or organizations. It can be two types: long-term investments, short-term investments. The long-term investments posted in non-current investment. The short-term investments posted in current assets with some different categories. Okay. Then working capital. What is working capital? So this is and the excess of current assets over current liability at a given moment of time. It shows in the asset side of the balance sheet. So generally we will show the current assets on asset side, current liabilities on liabilities side. Okay, right. But how to calculate working capital means current assets minus current liabilities. That means current liabilities deducted from current assets. What are all the items comes under current assets, or what is current assets? These are the assets that are expected to be sold, consumed, or converted into cash during a normal operating cycle of a company within the span of 1 year if the operating cycle of the company is shorter than 1 year. So what are all the assets should be converted into cash within the span of 1 year? That assets comes under the category of current assets. For example, stock, bills receivable, cash in hand, cash at bank, debtors like this. Okay. Then what is current liabilities? What it includes? It is an obligation that must be discharged by a company within normal operating cycle or within its normal operating cycle or within 1 year, whichever is longer. So, what are all the obligations? Thus, that must be the company repay to their claimants. That is called as creditors or customers, sorry, suppliers. Likewise, so within the span of 1 year, it should be taken. That comes under the category of current liabilities. What is capital employed? Total of each side of balance sheets represents company's capital employed. So total assets are shareholders funds plus long-term liabilities. That comes under the category of capital employed. So this is the format for balance sheet. So I take an example for one company balance sheet. It gives 5 years figures. So first at the end top current assets, sorry assets. The first part is current assets, cash and cash equivalents, net accounts receivable, inventory, other current assets. Then followed by fixed assets, capital assets, accumulated depreciation. We should deduct the accumulated depreciation from the capital assets. We will get net fixed assets value. After adding the current assets and the fixed assets value, we will get total assets. That is called as capital employed. Then followed by liabilities. First current liabilities, accounts payable, short-term notes, other short-term liabilities. We will adding these three items, we will get total current assets. Then followed by long-term liabilities. For example, debentures or loan from bank for more than 1 year like this. So after adding the current liabilities and the long-term liabilities, we will get total liabilities, followed by shareholders' equity or shareholders' funds. So first capital stock, that means share capital, then followed by retained earnings or reserves and surplus or profit and loss account. So these two we will take as shareholders net worth. So total shareholders net worth. After adding the total liabilities and total shareholders net worth, we will get total liabilities and the equity of the company. These are all the major important statement of balance sheet. Generally they will provide current year figure and previous year figure. For example, for collection of some data, I will take up for 5 years balance sheet. Okay. So first they will provide current year generally for preparation of balance sheet. First column they should provide for current year figure, then followed by previous year figure. Because of comparison made by the investors or shareholders or others. For that purpose, they will provide current year's figure and the previous year figure. Then the fourth statement is statement of owner's equity. So equity of the company comprises of three parts: paid up share capital, reserves and unappropriated profits. So first paid up share capital, then followed by reserves and surplus, then third unappropriated profits. So statement shows how these items increased and decreased over a financial year under report. Increase in share capital comes from fresh issue of shares, while decrease comes from redemption of shares. So if in case the company share capital increase remains, they may be issue fresh issue after completion of few years, maybe expansion of their business or open a new branches in other locations like this. Sometimes it may be decreased due to redemption of shares. For example, the company offered or issued at the time of offering shares, they may be issued redeemable preference shares. It may be for take for 5 years or 10 years. After the maturity date, the company should redeem their shares. That means that time they may be uh, reduce the share capital, right? So this is statement of owner's equity. So paid up share capital, then followed by reserves and surplus, as well as unappropriated profits. Okay. So notes to financial statements. Notes accompanying the set of financial statements published by a company provide the following additional information. So we will discuss one by one. An explanation of accounting methods or policies used. For example, companies are generally free to choose the method of computing depreciation on their fixed assets. Sometimes they may be taken for written down value method or original cost method. So based on the company's decisions, they will choose the method of providing depreciation. Okay, while Ali Limited calculated depreciation on its plant and machinery using straight line method. Bauer Limited may well opt to written down its plant and machinery using for diminishing balance. So depending upon the company's decisions, they will make or use the methods of depreciation. Generally, most of the companies using for the depreciation is diminishing balance method or return down value method, right? Then greater details regarding certain figures in the financial statements. For example, an income statement only one figure of cost of goods sold is given. Details of various figures marking up in the cost of goods sold during the year are given in the notes to accounts. For example, cost of goods sold it includes opening stock of products, then addition purchase made during the year, then deduct the closing stock during the year. It includes the cost of goods sold. So we can't be able to put it directly in the income statement. For that purpose, we provide or prepare notes to accounts. Then statutory disclosures. The law required company to disclose certain information in their annual accounts. For example, details of remuneration paid to directors and senior managers must be disclosed. So these are all the information separately disclosed. Then changing in accounting policies, methods, or nature of business during the year. If a company change may of its accounting policies or start a new line of business or abundance of part of its operations or if there is any significant change in the manner in which company conducts its business, information about such changes must be given in the notes to accounts. If in case the company made some changes in their business activities or to amend certain parts of its operations or to start a new line of business, all the particulars should be given in the notes to accounts. Then details of off balance sheet item, certain information may be important for the users of financial statements, but it may not have any rightful place within the body of any particular financial statements. So these are all the information provided in notes to accounts. Company need to publishing their financial statements. The information function. A large number of people have an interest in the affairs of company. The persons are called stakeholders. It includes shareholders, lenders, suppliers, customers, managers, employees, prospective investors, relevant governmental departments, and at the end, public at large. Their only source of information about the financial performance and health of the company is the annual report published by the company. So all the mentioned people to know the financial position of the company or financial performance of the company, how the company healthy. So with the help of audited annual report only. Okay. So these statements therefore serve to provide vital information to all those who have an interest in the well-being of the company. So they must publish for information function. They should provide information regarding their about their company. Okay, right. Then second one is the control function. On the basis of information obtained in the financial statements, shareholders can control the conduct of directors who manage the company. These financial statements, when compared with others from similar companies, can also help the investors set important benchmark for measuring the efficiency of the managers. So, with the help of their company and compared with other competitors company, then only they will measure the performance or efficiency of the managers. With the help of these informations, they will control their directors. Then the planning function. Financial statements of 1 year provide a basis on which to plan or budget for the next one or next few years. Detailed analysis of financial statements helps to set targets and make attainable plans in light of already achieved standards. So with the help of financial statements, they will plan what we will do in the future or what they make in the budgeted figures like for the forthcoming years or the next year. So the detailed analysis of financial statements helps to set target and make attainable plans. That is the most important. Then limitations of financial statements. Financial statements are very useful source of information to all those people who have an interest or stake in the company. However, financial statements suffers from some inherent defects. These are briefly discussed below, along with some advice on how to minimize the impact of these problems. So, most balance sheets shows value of assets, in particular or particularly fixed assets, at cost less accumulated depreciation. These values may be vastly different from the prevailing market value of these items because each and every year the company provide or deduct from their fixed assets in the form of accumulated depreciation, but actually the market value is different. That is the major difference showed in the balance sheet. No companies to uh, mention their market value of assets in their balance sheet. At the time of purchasing value of fixed assets only, they will show each and every year. Out of which they will deduct depreciation also each and every year. Okay. Then no one shown their market value of the assets. Then secondly, accounting principles of companies differ even within an industry. Example, one company may not treat a sale as a sale till the goods are paid for by the customer, while another company may book a sale as soon as items are delivered to the customer. Few companies, for example, they will send the goods to their customers. If the customers make the payment, then only they will consider as sales. Few companies to deliver their customers of their goods on the term of credit, they will mention as sales in their book. That is the difference. So it depends upon the accounting policies adopted by the company. Thirdly, financial statements contains absolute figures. For the purpose of evaluating financial performance or position, it is often necessary to compare one company's figures with those of other companies or the average of the industry. So they will provide absolute figures only. Okay. So it may be we can't compare the exact figure likewise. Sometimes it may be useful, or otherwise we will take for average of the company. Then fourth one, certain assets and or liabilities may not be shown in the financial statements. For example, contingent liabilities are often shown only in the notes to accounts. It should not include in the balance sheet of the company. They will mention only in the notes to account. Similarly, a company may opt not to show a deputed receivable amount and in its balance sheet till it's actually received. Yes, income earned but not received. They does not disclose in their balance sheet. After receiving only, they should include it. Right. So these are all the major limitations have in the financial statements. Then quality of financial statements. A good set of financial statements should have the following qualities. What are all the qualities have a financial statements? Each statement should be clear and understandable. So each and every statement should be clear as well as easily understandable by each stakeholders. Everyone should be easily understandable manner they should prepare. So the statement should be reliable. So it should be easily understandable as well as reliable to each and everyone. Then next quality is the statement should be honest. That means it should be a trustworthy. That means it should be shows in the honesty of the company. So they should prepare that the statement should be in the honest. The statement should contain all the disclosures required by the various regulatory bodies. So, regulatory bodies, it may be SEBI or RBI or even some government agencies. So, based on that, they should disclose all the required informations or chapters or contains should be included in the statements. These are all the major important qualities of the financial statements. The final category is audit report. So, what is audit committee role? The audit committee is the part of board of directors. It is assigned to specific responsibility by the board to ensure that financial statements proceed by the management and audited by the external auditors are worthy of board of recommendations for approval by the shareholders. In order to achieve this objective, the audit committee takes the following steps. So, before preparation and approval made by the shareholders, what are all the work done by the audit committee? It's review the internal control process of the company. It approves all of the company's procedure manuals, which provides them the opportunity to understand how the company carries out its various activity. So the internal control system review is the most important. Then only they will approve the procedure followed by the company. Okay, it reviews the reports of the internal auditor. In this way, committee is able to understand and evaluate the efficiency of company's accounting system and policies. So it should be helpful for review of the internal auditor's report. Then only they will make the decision what all the policies or all the system to be followed. It places the pivotal role in selection of external auditors, carrying out the verifying process and negotiating their terms and conditions. So the audit committee's report or the internal audit report should be helpful for the external auditor. Then the fourth one is it maintains relation with the external auditors and reviews all his communications with the company. So it should be maintained what all the reviews or the communications provided by the external auditor. It includes. It can go direct to the chairman or the shareholders if it feels that executive directors are in any way impeding its work. So it should uh, hand over to the directors or chairman or the executive directors. They impeding what they done in their work. Okay, these are all the major important role played by audit committee in a particular company. Then misleading financial statements. What are all the misleads in financial statements? So statements are said to be misleading if they are not consistent with accounting records on which they are purportedly based. So they cannot record consistency in the accounting records. Sometimes it may be uh, misleading. They are not based on accounting principles. They do not comply with applicable accounting standards and generally accepted accounting principles. They do not disclose the true profit or loss made by the company, meaning they do not include all the expenses and incomes or state them at correct accounts. So they properly followed the accounting principles. If they not followed means it may be some difficulties as well as what all the accounting standards accepted they must follow. If they can't applicable means it should be misleading the financial statements. Looks like for they does not disclose the true profit and loss. It may be misleading the financial statements. They do not include all the assets and liabilities in the balance sheet. They do not value of assets and liability of the company correctly. They do not provide adequate information or disclosure to help the users understand or evaluate them meaningfully. So if they cannot follow the proper accounting policies and procedure, the financial statements may be misleading to the different parties. So creative accounting, a systematic and intention misrepresentation of the true income and financial position of an entity to achieve certain objectives. This involves using such accounting policies and techniques that assist in misstating the financial statements. So creative accounting means they may be not followed the proper accounting procedures and other formulations. It may be misstating the financial statements. Then what is the major role played an external auditor? Stakeholders attach a lot of importance to external auditor's report because the external auditor is appointed by shareholders, not management. He is independent, not a part of company's management. He is competent to examine the accounts and financial statements and gives an opinion thereon. Only professionally qualified persons can get a license to act as internal auditors to a company. He is believed to have a high degree of integrity as he holding the uh, professionally is strictly regulated by the professional body. That means the external auditor must complete their chartered accountant degree. That is the most important. So he is not comes under the category of the management. The external auditor appointed by the shareholders only. He is an independent as well as he can examine all the accounts and financial statements in a proper manner. He has strictly regulated by the professional body. The final part of financial statements, audit report. What is audit report? This report is given by an external auditor after they have examined the accounting records, supporting evidence, and financial statements prepared on the basis of such records at the end of each year. It is essentially give the auditor's opinion on the financial statements, generally covering the following areas. So, based on the company prepared financial statements, he should be examined with proper evidence, supporting evidence like bills, invoices, and others. Okay. So, what are all the generally given the covering uh, information means steps taken by the external auditor to form his opinion on the financial statements. Auditor's opinion on whether or not that is the most important. The book of account has have been properly kept and complete in all necessary aspects. So the company must keep proper books and complete all necessary aspects. The financial statements are in accordance with the accounting standards. They must prepare their accounting statements as per the accounting standards, accounting records. The financial statements gives a true and fair view of company's profit for the year ended and its financial position at the end of the year. They must give a proper honesty value, true and fair value of the companies and their financial position at the end of the year. The financial statements provide all the disclosures required by the relevant laws. What are all the documents they may be prepared as per the relevant laws, they must provided. So in financial statements, what are all the international bodies available? So I just insist. So some of these international bodies or standards are applicable in financial statements. Accounting standard from IFAI, then ethical standards from ESB, audit standards from APP UK, Accounting and Audit Review Board UK, Public Company Accounting Oversight Board, Sarbanes-Oxley Act in USA. So these are all the international bodies or accounting standards provided for preparation of financial statements. That's the end of the unit.